Imagine waking up one morning, going to withdraw money from your bank account only to find it blocked. You're told you missed KYC deadline, but you never received any clear notice, and nothing about your identity or address has ever changed. This is happening across India. Families stranded, businesses stalled, people scrambling, all because banks requested the same documents year after year. Hi, friends, good morning. My name is Bharat Kapoor, banking analyst and associate of Dr. V.V.L.N.Sastry, jurist, international arbitrator, financial economist, and Fulbright scholar. As I introduced you with the preamble of KYC, now let us get into details of why the injustice happens with customers on account of KYC and the reasons around that contributing to the blocking or freezing of accounts of customers. Why does this happen? Isn't your PAN or Aadhaar already linked? Why must you submit physical proof again and again, just for keeping your own money safe? Let us take a look at what RBI requires and what it doesn't. The RBI mandates banks to follow a risk-based approach for periodic KYC updates for high-risk customers every 2 years, medium risk every 8 years, and low risk every 10 years. Banks may ask for earlier updates, but only if justified under documented internal policies, and they must notify customers clearly. RBI also mandates at least 6 reminders, 3 before the due date and 3 after, including 1 physical letter in each phase. Importantly, if the customer's KYC has not changed, a self-declaration is sufficient, no need for physical re-verification. Yet, many banks continue to freeze accounts arbitrarily without proper communication or justification. What went wrong? 1. No uniform notification channels, sometimes SMS, sometimes email, sometimes nothing. 2. Document overreach requiring PAN, trade license, utility bills and extra address proof, even if nothing has changed. 3. Field visits and selfie photos done in the name of compliance, but making customers feel policed, not served. 4. Short notice account freezing causing financial disruption and panic. RBI's June 2025 overhaul. On 12 June 2025, the RBI introduced sweeping reforms to reduce the KYC burden on genuine account holders, especially those classified as low risk. Such customers can now continue transacting even if KYC is pending, with a grace period of up to 1 year or 30th June 2026, whichever is later. Banks must issue at least 6 reminders, 3 before and 3 after the due date, with 1 physical letter in each stage. Customers can now update their KYC through any branch, business correspondence, BCs, video KYC, VCIP, Aadhaar OTP, or mobile apps, bringing accessibility and speed to the process. Even inoperative accounts can now be reactivated without visiting the home branch, via branch, BC, or VCIP. These reforms signal a paradigm shift from outdated compliance to customer dignity and inclusion. Why this matters? It provides for financial inclusion. Rural and subsidy-linked accounts will not be unfairly blocked. It helps in keeping customer dignity. Self-declarations replace repeated document submission, improve transparency. Reminder protocols create accountability. Ease of access must. Remote KYC updates eliminate unnecessary travel. The great irony: more KYC for funders, less for borrowers. Let's reflect on this paradox. Banks are built on the trust of depositors, the salaried, senior citizens, and small businesses who fund the system. Their money is the capital that banks lend and profit from. Yet, these funders are the ones facing repeated KYC demands: PAN, Aadhaar, GST, Gumanstha, utility bills, photos at your door, all just to keep your own account running. Miss one document? Account frozen. Meanwhile, borrowers, those taking money from the bank, have often escaped scrutiny. If banks had applied even half the KYC rigor on borrowers, India may not have seen the NPA fiascos we continue to battle. Why should someone depositing 1 lakh rupees be asked for 3 documents while someone borrowing 10 crore rupees does it with forged collateral or influence? This isn't just irony, it's compliance theatre targeted at the easy and honest. Let's reframe the KYC narrative. Yes, stringent KYC for loan takers is essential. Yes, KYC is needed for new accounts and material changes, but repeated KYC for unchanged, verified customers is excessive and unproductive. While closing this talk, let's ask the banks, where is your KYC for your own credit risk? Where is the transparency you owe to your real investors, that is your depositors? Conclusion and call to action. Banks are funded by depositors, SB, CA, FD, and RD account holders. Their money keeps the banking system alive. It is unjust to entangle them in bureaucratic loops while turning a blind eye to credit abuse. The RBI has taken a progressive step forward, but implementation is key. Banks must honor the low-risk extension and log every communication attempt. They must stop preemptively freezing accounts and accept self-declarations. They should focus on digital and BC-based KYC, not intrusive field visits or photographs. Friends, from our today's discussions, the takeaways are as follows. If your account was frozen due to redundant KYC, 1. Cite RBI's 12th June 2025 circular. 2. Request continuation of transactions as a low-risk customer until June 2026. 3. Remind them they must accept self-declarations when details haven't changed. 4. Escalate to the RBI's banking ombudsman if the bank fails to comply. If you found this video useful, please like, share, and subscribe to Dr. V.V.L.N.Sastry's channel. By spreading awareness, we can help hold banks accountable to RBI's reforms and protect every honest saver from being caught in a paperwork nightmare.